Edition of the final bar. We're going to look at the pullback in the markets. Quite the distribution during the trading day. A little bit of bounce here in the last hour, but we'll talk about what that means for the long-term trend. Certainly a lot of negativity that's emerging on a number of charts out there. So we'll talk about that, but also about the resiliency in places like gold and elsewhere in the markets. We're going to answer your questions from the final bar mailbag about relative performance, about technical indicators. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today and every weekday right after the close to debrief on what has happened in the markets connected to the long-term trends. Friday is one of my favorite shows of the week because it allows us to really focus on the long term. We've now locked in the weekly close for this week. We've now seen from Friday to Friday how the market's evolved. Now we can really think about the characteristics of this market, what it means for the longer term trends. Today, obviously, a lot of distribution, further worries and scare about the viral outbreak coming out of China, implications for that, a speculation of consumer slowdown, travel slowdown, how that's going to impact different markets. So in general, a lot of profit taking, a lot of negativity, a bit of a bounce going into the close, but overall, certainly weaker rather than stronger. So we're going to do some thinking today about what that means for the long-term trend. Overall, I think the long-term trend remains positive, but let's look at the charts to clarify those points. Before we get there, I wanted to remind you of the upcoming schedule on the show. So we have some really cool events coming up, some great guests. Next week on January 27th, we have Mark Ungewitter. On January 28th, we have Dana Lyons from the Lyons Share Report. So both of those fantastic strategists you're going to want to hear from. On January 29th of next week, we have our new documentary-style interview with Ralph Atkimpora called 50 Years on Wall Street. We just previewed a version of it this week here in the office, and Gretchen, the producer, the whole StockCharts TV team did a really fantastic job. You're going to want to see it, I guarantee you. The week after that, on February 3rd, it's the final bar on the road. We're actually heading to the Southeast U.S. to Atlanta and Orlando to do some interviews, go to the Money Show. We're going to share a lot of that great content with you, but that is coming up in a couple weeks. So a lot of really good things happening. We appreciate you continuing to watch and send your feedback and your questions to us. But let's get to the market recap. So, today it's gotten so comfortable to have these nice up days that just continue to trip higher. And I mentioned yesterday, the path of least resistance feels higher, boy, until it doesn't. And when we talked about the news coming out of China, it's a very fluid situation. And when you have that sort of event, that sort of speculation, the market can go up and go down very quickly based on news flow and what everyone's expectations are. When we get to the mailbag segment, we're going to talk in particular. I had a great question about the impact of the news directly on the markets, which I'll share with you. But certainly today is a negative reaction, thinking that that this could be a bigger issue than originally expected, and that could provide some downside move in equities and so forth. So the S&P finished down almost 1%, came up a little bit, 3295-ish for the close, but almost down 1%, 0.9% today. Small and mid caps led the way further. Small caps are really down the most, 1.5%. The VIX coming up pretty good now to 1460. It had been really muted for quite a long period of time. So there's a pretty quick acceleration to the upside in terms of volatility. In terms of the sector movements, we have utilities and real estate 1 and 2. This has been the theme the last couple of days. We've had a move toward defensive, but remember this whole thing about utilities being at the top of the list. This is not a new thing. This is not just because the market has pulled back. Utilities have been one of the strongest 2 or 3 sectors for most days in recent weeks, and it shows you that, again, don't worry too much about what you think the market is going to do, and then think about sector exposures. Look at the sector charts themselves, look at the RRG charts, which we'll look at in a little bit, and really look at where the rotations are happening. Tech number 3, and we're going to look at semiconductors later, remaining in a position of strength, which really suggests that there's further strength underneath the hood in the equity space. On the downside today, we had healthcare leading the way down, consumer discretionary in the financial sector. Financials is one of those things that's a little worrisome, right? You want to see financials in a position of strength in a healthy phase if the market overall is holding up pretty well. We've not seen that here. We've had a little stretch here where it's weaker rather than stronger. In terms of big movers today, and then we're going to get to some of the other headlines. Interesting to note, in a day when transport's sort of weaker, when there's a lot of speculation about negativity, you have something like Southwest Airlines actually doing just fine. So obviously there's this yin and yang of negative travel headlines, but earnings at the same time. And so where do things balance out between those? And I think what you're seeing with something like Southwest Airlines is it's resolving to the upside. The strength in the news flow for the company this week outweighs the potential negativity. Southwest, obviously more of a domestic U.S. carrier, so maybe cushioned a little bit from some news out of China, but overall, it's certainly people being comfortable with travel overall. Also, I wanted to go down here to see, WRB. I was going to say, it just switched to a stock I wanted to look at before it jumped too quickly. You're seeing some pockets of financials that are actually bubbling up just fine. And I did want to point out, even though a sector is down, remember, you can always look a little deeper. So even within financials, which is relatively weaker today, you have stocks like WRB, WR Berkeley, which is up almost 1%. So actually doing just fine. So remember, just because a sector is down doesn't mean that there aren't pockets within that sector that can be doing very well. And it's not surprising on a down day in financials, something like insurers would do a little better. That's more of a defensive side of the financial sector. But I would make a point of looking at some of those a little deeper. On the downside, the stocks losing the most in their scooter rankings today, we have things like Norwegian Cruise Lines. This makes sense. This is certainly a direct, I would say, impact on based on the news from China, worries about travel. And Starbucks is actually a really interesting one. This is a stock that people love to love. However, it's interesting to note it's become overbought, come out a little bit, and you actually have this, wow, I'm going to have to pull my candlestick analysis out of my head here from years ago studying for the CMT. It's called the dark cloud cover, if I remember right, where you have a big up day, a down day that doesn't eclipse the previous day's body, but gets over half of the way down. Pretty sure that's what it is. So tell me if I'm wrong, but I'm fairly certain that's it. But certainly more of a negative, showing you distribution on something like Starbucks, which is an interesting pattern to pay attention to. Also, Synchrony Financial down pretty good. So a number of gaps again on earnings season. You have a lot of gaps to deal with, and a lot of times earnings result in a polar reaction. Things go straight up, straight down. So pay attention to that. I did want to highlight before we get into the wrap the week segment, just looking at China in particular. So obviously all the news out of China, the question is, what does this mean to the Chinese ETFs? Which is how a lot of people are obviously going to play China if you're a US-based investor, a North American-based investor. You know, the FXI hasn't changed a ton. We've had the sell-off the last couple of days, so I think it's already sort of been baked into the price a little bit. The question now is this have staying power? Is there a further negativity? Is this going to be a longer process of quarantines and all of that investors would have to be concerned about? I think in terms of price, which is what we are trying to do here, we are right at support. So we're right at a consistent support level from previous resistance called the polarity level. We're right at the 50-day moving average. We're near a Fibonacci support level, just below 42. So we're sort of at this confluence of support. This is where you might expect something like the FXI to hold. The RSI actually would speak to that as well, right above the 40 level, which is where the previous pullbacks have bottomed out. So this is where you'd expect it to bounce. If it doesn't, though, if we start to break down through 42, get down through the Fibonacci levels, then you have to be a little more concerned. So from a technical perspective, we're right at support at a very key line in the sand, and certainly a chart to watch. Let's build on this discussion of China and today's markets and move on to our Wrap the Week segment. So this is where we like to look a little bigger picture at what's been happening, try to connect the short-term trends with the long-term trends, think about the overall movements in the market, and think as long-term investors should. I like to spend time here really in three places. I will try to get through all three of them, although I tend to get pretty excited looking at the Mindful Investor chart list and spend way too much time there. So we're going to start here. We're going to go to the RRG looking at sector rotation. Then we'll look at some of the scooter movers week to week and see what sort of themes have emerged. So starting off, this is a chart that I look at very closely in my weekly process. It's also a version of this weekly chart is the first chart I look at every morning as a way of making sure that I'm orienting myself to a proper long-term perspective. So if you look at the last 5 years, the trend is undeniably positive, and all the negativity we've had today, the distribution, is a little blip of a pixel down here on the far upper right corner within the context of this longer-term uptrend. So let's just keep in mind that the trend overall has been positive. This is the PPO based on the 21 and 34-week exponential moving averages remaining very strong, and the weekly MACD, or the weekly PPO using the traditional settings, is overall very positive as well. So even though we've had a bit of a pullback, the primary trend remains positive according to that particular measure using long-term moving averages. This is one of the charts I'm pretty sure I put as one of the 3 and 3 for the end of the show, because it's looking at breadth measures, and this is the one I like to look at, looking at large, mid, and small cap breadth. This doesn't update until later when we're able to lock in all the closing prices and make sure the data is accurate. So it'll be interesting to see over the weekend into Monday morning what these look like and how they update. But overall, I'd certainly expect the advanced decliners to go down. The question is how far down they go. Do they break to a new lower low, especially in the mid cap and small cap breadth line? So that's one thing to look at. We haven't had a lower low in breadth in quite a long period of time. That'd be a very different environment than we've seen. Also worth noting, the stocks making new highs or new lows. So we've had more and more new lows every day this week from the New York Stock Exchange. But again, it's only 37 stocks out of a couple hundreds, if not a couple thousand. I forget how many are in this universe, but it's a pretty big universe. And on the S&P, you only had 3 stocks. Again, this is not updating for today's trading, so expect a little more of stocks making new lows, but maybe not, because so many stocks are so elevated. So we'll have to see how they look. Now we're getting into some of the ratio analysis that I think really tells the story when you're looking at a weekly routine. For me, these are crucial, and it's telling you about rotations, it's telling you about asset allocation decisions, and where big institutions are moving their bets and how they're rotating. This is a chart we've looked at before, which is the ratio of consumer discretionary versus consumer staples. When this ratio is going down, it favors consumer staples. When it goes up, it favors consumer discretionary. So it's really offense versus defense within the consumer space. I've looked at this for years, and what we saw was this downtrend through most of last year, bottoming out in December, similar level to what we saw in August and October. We then rallied, and it broke above trendline resistance here at the end of the year, going into year end. Since then, you can see how it's rotated right back down, and we've now broken down. So as the new year has started, as stocks overall have moved higher, within consumer, it hasn't been as glowingly positive. It's been leaning a little more towards the defensive side, and you can see that this ratio is now once again breaking down. Down at the bottom here, this is the equal weighted version of that. So equal weighted consumer discretionary versus staples, coming down as well, and I think testing a new support level here. So if it breaks below these next couple points, below the lows in November and December, that's a new 3-month low in that ratio, and really tells you that people are going more towards the defensive side. I will say with any of these sector things, I think at this point it pays to be a stock picker. There are plenty of stocks that are going to new highs if you're screening for them effectively. The next one is looking at semiconductors. This is a great theme, understanding overall leadership. Semiconductors are a group that tend to lead in both phases. When this group is doing well, the overall market tends to be doing just fine. Semiconductors are continuing to outperform pretty handily. So until that ratio goes down, based purely on this, it's been in a consistent uptrend since the beginning of last summer. It's been a pretty slow and steady up move, sort of showing you that within technology, the leadership that should be at the top is doing just fine. Relatively speaking, it's doing okay. Interesting to note that momentum has shifted so quickly. So momentum as a factor was not super effective here at the end of last year, but year to date it has completely changed. So it's been paying to stay with the stocks that have been working on a relative basis. I want to switch now and go to the relative rotation graph, which is right here. We're going to reload this one. I tend to spend most of my time looking at a weekly version of this. We had a great call with Julius DeKempener this week, thinking about some ways to improve the RRG experience on StockCharts, and hopefully a lot of cool things that you'll be seeing over the course of 2020. But it was great to talk with Julius just about how he's thinking about this visualization. And again, it's so helpful to understand how the 11 sectors are rotating around the benchmark in the middle. I spend most of my time looking at a weekly version of it because it captures the long-term fluctuations, long-term rotations. What we've seen here over the last couple weeks is technology remains in a position of strength. And again, even with the pullback in stocks this week, overall, this is still telling you that tech has been the place to be, remains the place to be. You are not getting that sort of signal from financials or industrials, both of which are rotating to the southwest, which is not the direction of encouragement. That's a little more discouraging in terms of long ideas. What is starting to improve down here, if you look, are things like the XLU, which is utilities, XLY is consumer discretionary, XLRE is real estate. These are all sectors that are rotating north to northeast. And in general, if you own things that are rotating northeast, if you don't own things that are rotating southwest or you underweight them, overall, you're going to be on the right side of things. You're going to be in the sectors that are emerging and that are really starting to do well. Out of all the things I just mentioned, the one I didn't hit on that I would pay attention to is healthcare. This is a group that's been very interesting. We've talked about as sort of a sleeper pick, some really good charts within healthcare, but as a sector starting to rotate down a little bit, if that rotates more like financials, follows it to a position of weakness, I think you have to be a little hesitant about being too overweight something like healthcare right now if that's sort of the relative trend. Again, these are not based on pure price movements. It's the relative performance relative to the S&P 500, so really important to watch. I wanted to finish off looking at our scooter reports. It's one of my favorite things to do to understand week-to-week movements, and we just have a minute to look at some of these, but I did want to highlight it. If you switch the scooter report page to industry, switch it from intraday to 1 week, and sort on change, these are going to show you what groups have improved the most week to week and which ones have struggled the most week over week, so Friday to Friday. So at the top of the list, we have some boring stuff, ladies and gentlemen, things like multi-utilities, residential REITs. These are sort of yawner parts of the market, but they're the ones that have done the best. And you see the relative performance in utilities has been exceptionally strong up and to the right. It almost looks like tech. If you covered up the ticker of utilities, you might think it's something like tech or industrials, but it's been doing very, very well. So there are sectors, so there are stocks within those sectors that are doing very well. I think notable that railroads are doing so well, and railroads tend to be a good indicator about overall, shipping strength, economic strength, doing pretty well. Mortgage finance also in the financial sector. On the downside, non-ferrous metals, marine transportation, gambling. These are stocks that a lot of people have thought were very, very good, and myself, and indeed, things like LVS and others had these nice uptrends, nice breakouts, but really turned very quickly, and a lot of those stocks are struggling. Some of them, it's with Macau and the exposure in China, but worth noticing. Also, biotechnology, which is one of the sort of greener pastures within healthcare, struggling as well. So again, we just touched on the scooter reports. I'd encourage you to look through those, go through the names that comprise those. You can do that by going to the industry summary page and see what stocks are within those groups, but some really interesting themes to think about going into the weekend as part of your weekly review. We're going to take a quick commercial break. We're going to be back answering your questions from the Final Bar Mailbag. So we'll see you in a minute.
I'm going to tell you when the next bear market is going to begin. There will be a bear market, and it's going to begin and get really bad when we enter a recession. So the secret of staying out of bear markets is to watch out for recessions. If you can predict a recession or know that we're entering a recession, that's when you get out of stocks. Other than that, you really want to be a long-term investor. The long-term trend of stocks is up, except for when we have recessions. So recessions, huge impact on stocks. So watch out for them. Your trading, your investing will be so much better.
Hey everyone, welcome back to the show. Thanks as always for getting your questions and your feedback to us. We read everything you send. Really appreciate your feedback on trying to make the show better, but we especially appreciate your questions. We receive a ton of questions via email. I'd encourage you to please keep sending your questions. I'm going to try to get through 7 questions here in a moment, and they all come directly from you over the last 48 hours or so. So email us at thefinalbar@stockcharts.com. We'd love to look at your questions, answer them on a future show. But let's, folks, get to opening the Final Bar Mailbag. So as I mentioned, I'm going to try to get through 7 questions. Sorry in advance if I have to go a little quickly, but hopefully a lot of these were sort of quicker questions, quicker answers, and I'll try to be as brief as possible here and get my points across. So question number 1 came, again, these were over the last couple days, but came through our chat room. Do you think the coronavirus outbreak is affecting the transports, especially the airlines? And we mentioned this earlier in the recap. Absolutely. I think what you have to remember, and I think we talked about this earlier in the week, The markets aren't about the news and what is happening. It's all about investors' expectations of what's going to happen. And that affects how we react to earnings, how a price moves relative to earnings. It's not about how much the company earns. It's about what the company earns relative to the expectations, right? Do they do better or worse than expected? It has nothing to do, it rarely has as much to do about the absolute value of how much money they were gaining or losing over a quarter-to-quarter period. So it's something like the coronavirus. It's all about what's potentially baked into the price and what sort of fear or greed would emerge based on new headlines, or is there something new? And the challenge of something like the coronavirus outbreak is it's all very new, right? This is a new territory. This is not something we've dealt with for quite a while, since maybe SARS or Ebola or something. And so how the markets react to that, a lot of us are sort of out of practice or understanding it, but it's all speculation. It's all expectations about how these news items are going to impact stock. So your question about transports, I would say overall, certainly you've seen weakness in transports that can certainly be attributed to the news there. And it's all about how much people are going to feel comfortable traveling or not. I would point out, you're absolutely right, airlines down along with a lot of things today after a nice jump up yesterday. And as I mentioned earlier, the challenge right now is you also have a lot of the airlines reporting earnings. So they're reporting, positive or negative earnings, but it's also with all this other stuff happening. So something like Southwest, not down today when you'd expect all the airlines to be down because of nerves about travel. Something like Southwest is up just fine. So don't worry too much about the headlines. Hear the headlines, but look at the charts and see what people are actually thinking. A lot of times that'll be a better read on what's coming next. So thanks for that question. Second one, what's your favorite technical signal of a trend reversal? Moving average crossovers, RSI, PPO, PMO, or something other. I'm going to show you this chart of Home Depot. My short answer is for trend following, I tend to use something like PPO, and very similar to MACD if you're familiar with that. Almost identical, it just uses percents instead of dollar values, but overall the interpretation is basically identical. The way I think of the two of these is a perfect illustration with Home Depot. You've had a stock that's come up from 210 up to 235 over about a 4 to 5 week period. The RSI, which I would consider more of a leading indicator, telling you what's happened. This is telling you when it's overbought, that the market's gone too high, too quick, that Home Depot potentially a little overextended. But you can see that the PPO at the bottom continues to be positive because this is more of a trend following device. So the RSI is the leading indicator. That will tell you things are getting overextended. Maybe put it on your radar. The downtrend, the sell signal on something like the PPO would tell you that the trend is actually reversed. You saw that back here in September. So if you saw when the stock rallied, became overbought, the PPO was still positive, the price turned down a little bit, then you get a sell signal from the PPO telling you that it's a little more of a correction. That's in general how it tends to work. So PPO or MACD is not going to anticipate the move, it's going to confirm the move, but that is the definition of trend following. And so that's the one that I would tend to use on daily, especially on weekly charts. You'll see it on a lot of my weekly charts. I'll do the weekly PPO. My next question very quickly was on banks. What does this mean in terms of bank strength? How important are the strength in the banks relative to the rest of the market? What does this tell you? Is this a bellwether group for the rest of the markets? And the answer is pretty much, right? I think one of the things that we look for, this is the Mortgage Finance Index here, DJUSMF. And here I'm looking at the RSI, the PPO. I'm going to put the relative performance right here. Sorry, there we go. So now I'm looking at the relative performance of the two. In general, these are the companies that are creating mortgages, that are helping people buy homes, and overall, what does the strength or weakness of this group mean for the overall market? Again, I think broadly speaking within financials, I would feel better about the overall market if financials were doing better, if the sector was holding up well, the sector was outperforming. There are plenty of times in history where the market's done well without financials, but I would feel much better with the confirmation of knowing that the finances, the finances of the company of the country are maintaining a position of strength. So I would love to see the relative performance on a group like this increase. I would love to see the price more at new highs. That would suggest to me overall strength. All the other news related to this, I think, is much less important than the price. What is that group actually doing? And I'd love to see financials participate. I think that would be a great bullet point on a bullish thesis. Next question, the 10-year yield broke down today below support. Isn't that a bearish signal for stocks? The short answer is kind of, yes and no. A lot of people love to look at one versus the other. Bond prices do X, which means stock prices should do Y. Here, I'm sort of butchering your question a little bit, but bear with me. I'm looking at the TLT, which is bond prices, so sort of the inverse of the bond yields, right? And I'm looking in blue, I'm showing the S&P 500 in the background. At the bottom, I'm showing the correlation of the TLT bond prices with the SPX stock prices. Overall, you can see periods like recently where stock and bond prices have actually been moving up together, which is why that's sort of a positive correlation, but there are plenty of other times where it's been a strong negative correlation. So these two things, stock and bond prices, are not 100% anti-correlation. The one does well, the other does poorly. It's very fluid. So I don't think you can draw that direct relationship and say whether or not it's going to happen. Remember, yields break up and break down within a much broader, more complex system of things, which creates the financial market. So I don't think you can draw a direct comparison, unfortunately. But thanks so much for that question. It's a decent question. The next one, we talked about commodities yesterday, I want to say, or the day before, and someone asked about K1, said the PDBC is a commodity ETF without K1s, and I think that's absolutely right. There are plenty of things to decide beyond just whether or not you want to own a particular ETF, the K1s, which happens with a lot of commodity trusts and other things. So certainly pay attention to it, and as well as I bucket that on things like expense ratios and other things you probably want to be familiar with that we don't touch on as much. So certainly look for the best way to get exposure on certain things. We are going to make it, ladies and gentlemen, through these 7 questions if it kills me. Number 6. I love your list of industry groups on the front page. This is a list that I refer to all the time on my member dashboard. The short answer is I painstakingly and meticulously went through the 11 S&P sectors and put all these titles so that I could see sector, NDC, industry. You are welcome to do all of that legwork on your own, or shoot me an email at thefinalbar@stockcharts.com. Tell me you want my industry watch list, and I'm happy to send it to your login. You can enjoy it, put it on your desktop, and do whatever you like with it as well. So just shoot me an email. Happy to do it. The last question, we made it, folks. How do you scan for when relative strength of Pepsi to the spiders goes above 0? The short answer is, boy, we cannot do it yet. The longer answer is, we are working on it. That's one of the things we've certainly identified that we want to be able to screen on. So it's in the works. Hopefully, I'll be able to share the positive results and share with you how you can do it on our system very, very soon. Thanks for those 7 questions. Those all came from you, the viewers, over the last 2 days. Really appreciate you taking the time to write in. Hope I was able to answer in some small way. And folks, we need to wrap the show with the 3 in 3. So at the end of every show, 3 charts, 3 minutes. Let's get to it very quickly. Breadth is going to be very, very important, and we've talked about it for a while, but I think it's going to be especially important if we do get more of an extended pullback. It's interesting, we have this sell-off leading into the weekend, and I'm going to be interested, along with many of you, to see what sort of follow-through we get next week. And I think a lot of that will be the news that we'll get over the weekend and see what that might mean. But I think one of the ways you can determine whether or not this is going to be a short-term pullback or something more deeper and more painful is by looking at breadth. And the way I'm going to do it is looking at the breadth by capped here. This is one of the charts on my Mindful Investor chart list, which I really like because it shows you large cap, mid cap, small cap, and then the New York Stock Exchange, sort of everything all in one big bucket. And I like to see how they move relative to one another. In general, you would expect small cap breadth to be weakest if people are getting more conservative because they're going to flow to safety. And so you'd expect the large cap breadth to hold up, small and mid cap to rotate lower. And if I start to see the breadth lines break to new swing lows, I'll start to get a little more concerned than I am at this point. The second for my 3 in 3 is one we looked at earlier, looking at offense versus defense in the consumer sectors. You know, there are a lot of things that drive the movements on these charts. Netflix is a huge weight in consumer discretionary, and not just Netflix, things like Amazon. A lot of things are, a big stock like those can weigh on an ETF, a sector ETF like this. So if one of those names is struggling, it can completely change the characteristic, which is why I like to look at on a cap-weighted basis, also on an equal-weighted basis. This is the most important one that I'm watching, and to see if the equal-weighted ratio goes below the lows from last November and December, that would tell me a little more of a flight to safety within consumer staples, maybe a little cause to be concerned. But my third for the 3 in 3 is semiconductors, and I've often gotten caught at times on the wrong side of things because I didn't just pay attention to the fact that semiconductors are doing well. So when semiconductors are doing well, it's not a guarantee that the market's going to keep going higher, but in general, that tends to be a characteristic of a bullish phase. So I like to look at all these different ratios, all the breadth, all the sector rotations, all these key groups, and see what they're telling me and how I can draw that into some larger conclusions about the overall health of the market. And if this ratio continues higher, for what it's worth, semiconductors are still in a position of strength telling you that the market's in pretty decent shape. Ladies and gentlemen, that's our show for today, and that's a wrap for this week. Thanks for joining us on a Friday afternoon. We appreciate all your questions. Again, all the questions we answered today came from you in the last couple days. Please keep them coming. The Final Bar at StockCharts.com. You can also get to us on Twitter at FinalBarSCTV. Go to our YouTube channel. Check out all of our previous shows, not just for the Final Bar, but all the other fantastic shows and hosts on StockCharts TV. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend.